Blake Hooper here, blakehooper.com, and today I'm going to show you the exact strategy that I've used over the last 3 years to invest in five separate properties. So firstly I'll bring up the properties. So the first one I bought was in Sydney. I bought another one in Sydney, which is the one that I actually live in with my wife. I've then got another one in Brisbane, and I've got another one in Brisbane. The one that I purchased here had a granny flat on it as well. So the first one I bought here in Brisbane, in Sydney, I got at a great rate, obviously just before the boom, and it's been fantastic because it's had a lot of growth. This one's also had a substantial growth as well. But the beauty of this is when I purchased it, it was neutral. So when I say neutral, means that the outgoings or the expenses for that property are roughly about the same cost as the incoming, so the rent and things like that. And the reason that that's really good is it helps you move into your next property quicker, because if you have to spend about $100, $200 a week here to maintain this house, it's going to stop you from moving because it's tying up your cash flow. Then let's have a look at this one. So for instance, they're all on, let's say, roughly 4.5% interest rates. This one's at 4.5% interest rates. And all the ones that I don't live in are on interest only. So the good thing about that is every single one of these houses here is either neutral or positive. This one is neutral still. This one here is neutral. And then we've got this one here which is positive. So what you want to do is you want to get to a positive situation. The great thing here is this one puts about $5,000 a year in my pocket. Now I'm going to show you how to put $5,000 a year or more from the other properties into your pocket. So this one here is going to have a granny flat. That's pretty much in the planning stages, so that one's going to have a granny flat. This one here, the one that I live in, eventually will become a rental. That way I don't pay any extra taxes or anything like that, and it will have a granny flat on it. And this one over here will also have a granny flat on it. So what you're essentially doing is you're going to have 8 income producing properties in your portfolio. Now these ones have obviously had really good growth. Brisbane here hasn't had exactly the same amount of growth, but I'm more about the rental returns, because you want to have a strong rental return because that's what you're going to retire on. If you're wanting to buy and flip houses and sell them quickly, yeah, growth's a great strategy, but you've obviously got a lot of taxes, you've got agent fees that you've got to pay for selling, things like that. So what the strategy I like is the buy and hold. These properties will never be sold. The reason being is because they're cash cows. So this one here, putting in $5 grand a year, if these are all putting in $5K a year, now as rents go up, that becomes $6,000, $7,000, $8,000, $9,000, and that's essentially the wage that you're going to have to live on, and that's with loans, because you have obviously a loan that's attached to this property. As you start to pay down these loans, so you start to reinvest some of the profits back into the houses, the loans start to come down, and these profits up here start to skyrocket even further. So the reason I'm showing you all of this is because just over 3 years ago, me and my wife, we had $30,000 in a bank account, and if you value all of these properties now and whatever's left over in the bank at the moment, we're getting close to having $1 million, and that's in 3 years. So that's from working on a strategy that's buying and investing in properties and seeing growth in those properties. The other thing that I always like to do is I like to go in with a 10% deposit, and the reason being is if you can do whatever you've got to do, Uber drive, work 3 jobs, have a business on the side, whatever it is you need to do to get more money into your bank account each year so that you can invest with a 10% down on each property there. It really helps you because it keeps your loan ratios low. So the loan ratios are down, they're not exactly the value of the property that you actually bought. It helps a little bit with making them start off in a neutral or positive situation. And it also goes a long way to keeping that risk down and stopping you from having all your eggs in that basket and going, wow, if property prices dive, or if I don't have this tenanted, then I'm on my way out. So definitely do as much as you can to build up as much around your savings so that you can put that into the properties. But as you can see from this strategy here, these 8 properties here, I've mapped them out over the next 10 years, 20 years, 30 years with conservative growth. And at the highest rate, these properties were valuing in at almost 20, at roughly 20 million, based just on those values there, if they were to increase at reasonable rates like that, less than what they have in the last 30 years. So as you can see there, it's not basically this strategy here is a bit of set and forget. You don't have to work on this business day in and day out. You have property managers that look after your houses for you, and they'll look after the tenants, they'll take the rent, they'll get any repairs done. So basically, it's one of those things that you're probably spending 10 hours a year or something roughly on each individual property, and that's to do your tax, to deal with the property manager, to assess the situation, pay your mortgages. A lot of that's obviously on auto as it just comes out of your offset account. But as you can see, this business here can be highly profitable, and the best bit about it is anyone can get into it. It's not the entry level is basically get yourself a deposit, pay some stamp duty, and you can be in this business. So I hope you can see the strategy here that I've used and how I'm using granny flats to leverage an income from those properties to ensure that they run in a positive range. If anyone tells you to go negative, then they got rocks in their head, and you should not be looking into that strategy. If people are telling you to buy new off the plan houses, also be careful of this. One thing very important about this is every single one of these houses was an established premises, so they're all 20, 30, 40 years old. If you're going and buying new for depreciation and things like that, you're paying developers for their fat checks on top of it. So just be very careful if you're getting into that area. Definitely buy established properties. I think put a granny flat on there. Some people like to just have the property, but I definitely say put a granny flat on there and keep these properties for the long term, because that's where you're going to get them to become income producing fat cats. Because essentially once this loan gets down to nothing, once there's zero remaining on this loan, and you're diverting all of the profits into this one to pay off this one, so that you've then got a zero loan as well, that's when you're going to get all of the rental income coming from here. All of the income is going to be basically going into your bank account, and that's what you can live on, that's what you can retire on, and you can easily have a six-figure income just on this, as long as you continue to push the profits back into the properties in 10, 20 years. Plus, obviously, it doesn't stop there. It's not like you stop buying. You continue to buy, and essentially it's a foregone conclusion. There's going to be plenty of cash. It's a great business. It doesn't take a lot of work, and it's something that you should be setting up, and I wish I had to set up a lot earlier.